much lower than present prices, to be considerably more than compensated for by prospects of profit. As you know, we buy marketable stocks for our insurance companies based upon the criteria we would apply in the purchase of an entire business. This business valuation approach is not widespread among professional money managers and is scorned by many academics. Nevertheless, it has served its followers well, to which the academics seem to say, well, it may be all right in practice, but it will never work in theory. Simply put, we feel that if we can buy small pieces of businesses with satisfactory underlying economics at a fraction of the per-share value of the entire business, something good is likely to happen to us, particularly if we own a group of such securities. We extend this business valuation approach even to bond purchases, such as WPPSS. We compare the $139 million cost of our year-end investment in WPPSS to a similar $139 million investment in an operating business. In the case of WPPSS, the business contractually earns $22.7 million after tax via the interest paid on the bonds, and those earnings are available to us currently in cash. We are unable to buy operating businesses with economics close to these. Only a relatively few businesses earn the 16.3% after tax on unleveraged capital that our WPPSS investment does, and those businesses, when available for purchase, sell at large premiums to that capital. In the average negotiated business transaction, unleveraged corporate earnings of $22.7 million after tax, equivalent to about $45 million pre-tax, might command a price of $250 to $300 million, or sometimes far more. For a business we understand well and strongly like, we will gladly pay that much. But it is double the price we paid to realize the same earnings from WPPSS bonds. However, in the case of WPPSS, there is what we view to be a very slight risk that the business could be worth nothing within a year or two. There also is the risk that interest payments might be interrupted for a considerable period of time. Furthermore, the most that the business could be worth is about the $205 million face value of the bonds that we own, an amount only 48% higher than the price we paid. This ceiling on upside potential is an important minus. It should be realized, however, that the great majority of operating businesses have a limited upside potential, also, unless more capital is continuously invested in them. That is so because most businesses are unable to significantly improve their average returns on equity, even under inflationary conditions, though these were once thought to automatically raise returns. Let's push our bond as a business example one notch further. If you elect to retain the annual earnings of a 12% bond by using the proceeds from coupons to buy more bonds, earnings of that bond business will grow at a rate comparable to that of most operating businesses that similarly reinvest all earnings. In the first instance, a 30-year, zero-coupon, 12% bond purchased today for $10 million will be worth $300 million in 2015. In the second, a $10 million business that regularly earns 12% on equity and retains all earnings to grow will also end up with $300 million of capital in 2015. Both the business and the bond will earn over $32 million in the final year. Our approach to bond investment, treating it as an unusual sort of business with special advantages and disadvantages, may strike you as a bit quirky. However, we believe that many staggering errors by investors could have been avoided if they had viewed bond investment with a businessman's perspective. For example, in 1946, 20-year AAA tax-exempt bonds traded at slightly below a 1% yield. In effect, the buyer of those bonds at that time bought a business that earned about 1% on book value, and that, moreover, could never earn a dime more than 1% on book, and paid 100 cents on the dollar for that abominable business. If an investor had been business-minded enough to think in those terms, and that was the precise reality of the bargain struck, he would have laughed at the proposition and walked away. For at the same time, businesses with excellent future prospects could have been bought at or close to book value while earning 10%, 12%, or 15% after tax on book. Probably no business in America changed hands in 1946 at book value that the buyer believed lacked the ability to earn more than 1% on book. But investors with bond buying habits eagerly made economic commitments throughout the year on just that basis. Similar, although less extreme, conditions prevailed for the next 2 decades as bond investors happily signed up for 20 or 30 years on terms outrageously inadequate by business standards. And what I think is by far the best book on investing ever written, The Intelligent Investor by Ben Graham, the last section of the last chapter begins with, "Investment is most intelligent when it is most businesslike." This section is called A Final Word, and it is appropriately titled. We will emphasize again that there is unquestionably some risk in the WPPSS commitment. It is also the sort of risk that is difficult to evaluate. Were Charlie and I to deal with 50 similar evaluations over a lifetime, we would expect our judgment to prove reasonably satisfactory. But we do not get the chance to make 50 or even 5 such decisions in a single year. Even though our long-term results may turn out fine, in any given year, we run a risk that we will look extraordinarily foolish. That's why all of these sentences say Charlie and I, or we. Most managers have very little incentive to make the intelligent but with some chance of looking like an idiot decision. Their personal gain/loss ratio is all too obvious. If an unconventional decision works out well, they get a pat on the back, and if it works out poorly, they get a pink slip. Failing conventionally is the route to go. As a group, lemmings may have a rotten image, but no individual lemming has ever received bad press. 1984. Some thoughts about investing. Investment is most intelligent when it is most businesslike. The Intelligent Investor by Benjamin Graham. It is fitting to have a Ben Graham quote open this discussion, because I owe so much of what I know about investing to him. I will talk more about Ben a bit later, and I will even sooner talk about common stocks. But let me first tell you about 2 small non-stock investments that I made long ago. Though neither changed my net worth by much, they are instructive. This tale begins in Nebraska. From 1973 to 1981, the Midwest experienced an explosion in farm prices caused by a widespread belief that runaway inflation was coming and fueled by the lending policies of small rural banks. And then the bubble burst, bringing price declines of 50% or more that devastated both leveraged farmers and their lenders. 5 times as many Iowa and Nebraska banks failed in that bubble's aftermath than in our recent Great Recession. In 1986, I purchased a 400-acre farm located 50 miles north of Omaha from the FDIC. It cost me $280,000, considerably less than what a failed bank had lent against the farm a few years earlier. I knew nothing about operating a farm, but I have a son who loves farming, and I learned from him both how many bushels of corn and soybeans the farm would produce and what the operating expenses would be. From these estimates, I calculated the normalized return from the farm to then be about 10%. I also thought it was likely that productivity would improve over time and that crop prices would move higher as well. Both expectations proved out. I needed no unusual knowledge or intelligence to conclude that the investment had no downside and potentially had substantial upside. There would, of course, be the occasional bad crop, and prices would sometimes disappoint. But so what? There would be some unusually good years as well, and I would never be under any pressure to sell the property. Now, 28 years later, the farm has tripled its earnings and is worth 5 times or more what I paid. I still know nothing about farming and recently made just my second visit to the farm. In 1993, I made another small investment. Larry Silverstein, Solomon's landlord when I was the company's CEO, told me about a New York retail property adjacent to NYU that the Resolution Trust Corp was selling. Again, a bubble had popped, this one involving commercial real estate, and the RTC had been created to dispose of the assets of failed savings institutions whose optimistic lending practices had fueled the folly. Here, too, the analysis was simple. As had been the case with the farm, the unleveraged current yield from the property was about 10%, but the property had been undermanaged by the RTC, and its income would increase when several vacant stores were leased. Even more important, the largest tenant, who occupied around 20% of the project space, was paying rent of about $5 per foot, whereas other tenants averaged $70. The expiration of this bargain lease in 9 years was certain to provide a major boost to earnings. The property's location was also superb. NYU wasn't going anywhere. I joined a small group, including Larry and my friend Fred Rose, that purchased the parcel. Fred was an experienced, high-grade real estate investor who, with his family, would manage the property. And manage it they did. As old leases expired, earnings tripled. Annual distributions now exceed 35% of our original equity investment. Moreover, our original mortgage was refinanced in 1996 and again in 1999, moves that allowed several special distributions totaling more than 150% of what we had invested. I've yet to view the property. Income from both the farm and the NYU real estate will probably increase in the decades to come. Though the gains won't be dramatic, the two investments will be solid and satisfactory holdings for my lifetime, and subsequently for my children and grandchildren. I tell these tales to illustrate certain fundamentals of investing. You don't need to be an expert in order to achieve satisfactory investment returns, but if you aren't, you must recognize your limitations and follow a course certain to work reasonably well. Keep things simple and don't swing for the fences. When promised quick profits, respond with a quick no. Focus on the future productivity of the asset you are considering. If you don't feel comfortable making a rough estimate of the asset's future earnings, just forget it and move on. No one has the ability to evaluate every investment possibility, but omniscience isn't necessary. You only need to understand the actions you undertake. Forming macro opinions or listening to the macro or market predictions of others is a waste of time. Indeed, it is dangerous because it may blur your vision of the facts that are truly important. When I hear TV commentators glibly opine on what the market will do next, I am reminded of Mickey Mantle's scathing comment, "You don't know how easy this game is until you get into that broadcasting booth." 2013. A final note on Buffett-related investing. In the first edition of this book, we sought to identify what investing well within a circle of competence looked like by quoting Buffett on investments in areas, insurance, consumer non-durables, and newspapers, with which he was intimately familiar. We think a better approach is simply to refer readers to his annual letters, in particular reading his successive annual commentaries on his insurance businesses, National Indemnity, early on, Berkshire RE, General RE, Geico, and other specialty lines, should provide a better idea of what a competent business understanding looks like. Readers should then consider how well they would fare in an insurance business transaction if someone like Warren Buffett were on the other side of the trade. Robert H. Heilbron, Investing in Investors. In 1929, shortly after Robert Heilbron had enrolled at the Wharton School, his father died. Heilbron left school to take over the management of the family leather trade business. That would have been a large enough challenge for anyone his age, but the onset of the Depression made things even more difficult. In addition to the business, His father had also left an investment portfolio of stocks and bonds. This too became Heilbrun's responsibility. It was not one of the joyful moments in investment history. The markets were already down a sickening amount in that year alone, and Heilbrun, though he had worked in the leather business in summers and on vacation, had no experience in managing money. To gain some understanding, he enrolled in courses given by the stock exchange and by New York University. With none of them providing him with the kind of practical information he needed, he remembered that his father had told him about an investment advisor he knew and trusted, a man named Ben Graham. Heilbrun looked up Graham in the telephone book and called him. Graham did remember Heilbrun's father, and the two made an appointment. As Graham later told Heilbrun, given the circumstances at the time, he thought Robert was coming to ask for a loan. In fact, Heilbrun wanted more. He wanted Graham to become his investment advisor and help run the portfolio. Graham agreed, but told Heilbrun there would be a fee of $25 a month. Heilbrun, recognizing a bargain when he saw one, accepted. They started to examine the holdings in the portfolio. Heilbrun's father had taken a large position in high-grade utility bonds. Though some utility firms had become holding company pyramids and collapsed in the crash, Heilbrun's bonds held up well. They were paying interest and selling at close to par. Graham's advice took Heilbrun by surprise. He said they should sell the bonds. Why? Heilbrun asked. They are good securities. Exactly, Graham told him, and they will never be worth more than they are today. And what would they buy with the proceeds from the sale? Heilbrun wanted to know. The bonds of Fisk Tire and Rubber, Graham responded. He told Heilbrun that although the company was in bankruptcy and the bonds were selling at 30 cents on the dollar, Graham was confident that Fisk would reorganize and that holders of the bonds would receive $700 in new securities for each $1,000 bond they held. This was Heilbrun's introduction to value investing. Heilbrun decided to follow his advice. After all, he was paying $25 per month for it, and called his broker with instructions to sell the utility bonds and buy Fisk. An hour or so after he placed the order, the brokerage firm called him back. They would not buy the Fisk bonds, they told him. They were a high-class firm, and they thought their reputation might be tarnished if word got out that they were dealing in bankrupt paper. When Heilbrun recounted this response to Graham, Graham told him the brokerage firm was simply wrong, that the bonds would prove a successful investment. Heilbrun moved his business to another broker who was Graham's brother and stayed with him for many years. The Fisk bonds did come through as Graham predicted, and Heilbrun was convinced that Graham was indeed a brilliant investor. He sent other members of his family to see Graham, and he himself began to advise them using the knowledge and insights he was picking up from Graham. In 1934, Graham and Dodd published their book, Security Analysis. Heilbrun was so taken with it that he enrolled in Graham's course at Columbia, taught then as an extension course at night, and thus available to people working during the day. Heilbrun found him a superb teacher, and the fact that Graham dissected the financial statements of companies that he was buying for Heilbrun's portfolio did nothing to diminish Heilbrun's interest. By the time the course was over, Heilbrun realized that he had had enough of the leather business. He wanted to work for Ben Graham, a desire shared by many students fortunate enough to take the course. But Graham at that time had no need of another employee. Instead, he suggested that Heilbrun become an independent investigator. He and Graham would discuss certain investment ideas, and Heilbrun would do the legwork, call the companies, visit them, and find less obvious ways to get more information about them. Though the Securities Act of 1933 and the Securities Exchange Act of 1934 had recently been passed, it took time for companies to make public all the information we now expect. There was no internet, no Edgar database, no free Edgar or any of the other wonderful tools investors can now summon at the click of a mouse. So much the better for energetic and clever researchers. Around 1937, Benjamin Graham bought a large block of stock in a gas pipeline company for Graham Newman, the investment partnership he had formed with Jerome Newman. To get the information he needed, Graham went to the State Public Utility Commission, where all public utilities were required to file detailed documents describing their operations. Heilbron adapted the approach to investigating Government Employees Insurance Company, an insurance company in Texas, and found what he was looking for in the state insurance office. Graham Newman owned a large position, and Heilbron was able to enrich their knowledge and understanding of the company. But Heilbron also discovered that it was a violation of the law for an investment company to own a controlling interest in an insurance company. Graham Newman solved this problem by distributing the shares directly to their limited partners, who then owned it directly. Government Employees Insurance Company, now known as Geico, has been the object of value investors' interest for decades. After Graham Newman distributed the shares, the company attracted the attention of Warren Buffett, who made a well-chronicled trip to Washington to learn what he could about the company and spent a Sunday talking with the chairman. After some ups and downs, the company nearly went bankrupt. It eventually was bought out entirely by Berkshire Hathaway. Heilbron worked on other Graham Newman Depression-era investments that also paid off handsomely. The real estate market in New York was pummeled by the Depression, the damage made more severe by overbuilding in the 1920s. When developers and owners defaulted on their mortgages, title companies would take a number of them, package them together, and sell them as bonds. Securitization of loans has a longer history than many of us realize. Bonds backed by mortgages in default sold at deep discounts to their face value, and Heilbron, along with Graham Newman, bought a substantial amount. They anticipated that at some point the demand for New York City real estate would return. Another series of bonds had been issued to finance the building of the Waldorf Astoria Hotel. They came out in 1929, paying 6% interest. Even the city's most prestigious hotel could not fill its rooms in the early 1930s, and interest payments were suspended. With the bonds in default, prices dropped to 30 cents on the dollar, or $300 for a $1,000 bond. At that price they looked attractive, and since the Chase Bank was willing to lend buyers $250 on each bond, the cost to the investor was only $50. Some years later the bonds were repaid in full, including all the accrued interest. Buying damaged goods paid off handsomely. Heilbron continued to invest with Graham Newman, to do research, which he shared with him, and to do some investing on his own. He sold his leather business to concentrate on investing. His approach was to apply what he had learned from Graham, find the bargains. In that period, when Barron's published annually a list of low-priced stocks, Heilbron and Graham would examine the companies on the list and buy the 10 best as a basket. Some might disappear, but the ones that worked out more than made up for the losers. And he followed Graham's practice of comparing two companies in the same industry, like Bethlehem and Crucible Steel, to see which was cheaper on an intrinsic value basis. Their focus was the balance sheet, not the income statement. They were able to discuss these ideas and pick up other suggestions from a community of value investors that had formed around Graham. One lasting interest of Benjamin Graham and this circle was the search for quantitative trading formulas that could be used to direct market investment strategies in a disciplined way. Heilbron contributed to the development of these kinds of rules in an article published in 1958. The method prefigured many of the formulas used by quantitatively oriented value investors today. Heilbron examined the price, earnings, and dividend histories of specific companies to establish the ranges of the P/E multiple and the dividend yield within which the securities had traded. The investment strategy based on this information is to buy stocks when they trade in the lower portion of their historical P/E multiple range, within the higher portion of their dividend yield range, or both. By establishing the ranges with precision, this approach provides a check on the emotions that can distort investment judgment, both the exuberance engendered by a rising market and the despair occasioned by a falling one. It applies a discipline for buying stocks when they are cheap, and usually more valuable, a discipline for selling them when they are dear. In a paragraph perhaps more timely today than when he initially wrote it, Heilbron warned that a feeling of over-optimism in bull markets is one which must be very carefully guarded against by the professional investor as well as by the amateur, since it is generally acknowledged that both are influenced by the tremendous quantity of bullish sentiment in newspaper and magazine article, speeches, reports, analyses, which emanate from the financial district. This statement is in no way to be construed as a criticism of the security analyst, but being human, and this is probably a disadvantage in this profession, he is subject to the same psychological pressures as everyone else. Heilman's innovation was to focus on the variability of a single stock as it traded within its historic ranges, identifying its highs and lows as compared with itself. The more customary value approach has been to search for stocks with low P/E's, high dividend yields, or low price-to-book multiples, as measured simultaneously against other stocks in the universe. Modern quantitative techniques developed by major value-oriented institutions such as Sanford Bernstein have combined the two approaches. They look at where stocks are trading relative to their historic valuation ranges and then compare stocks with one another based on these results. They identify those at the lower end of their own ranges and then test each stock against certain other criteria. If the price of the stock no longer falls when additional bad news is announced, that is a good sign. If insiders and other knowledgeable investors are buying, that is another positive sign. The initial quantitative screen, as confirmed by the subsequent stock-by-stock examination, produces a disciplined overall evaluation. In his own practice, Heilbron embodied one of the core principles of value investing. The circle of professionals that formed around Ben Graham included two men who actually worked for Graham Newman, Walter Schloss, and in the mid-1950s, Warren Buffett. Buffett, as all his followers know, had come to Columbia Business School to study with Graham after having read The Intelligent Investor. After a while, Heilbron began to think that the best investments he could make were in Graham, Schloss, and Buffett. He put money into Buffett's partnership a year or so after it started, and he also entrusted some funds to Walter Schloss after initially deciding against it. In later years, he added other prominent value investors to his portfolio of managers. These decisions paid off handsomely, and Heilbron was able to retire, more or less, from direct, active investing. By entrusting his assets to other managers, Heilbron embodied a version of one of the enduring precepts of value investing: know what you know, and stay within your circle of competence. Investments records are not definitive, but it does seem clear that a small number of professional investors, disproportionately of the value persuasion, have been able to earn above-market returns over the long term. The likelihood of mere good fortune as an explanation is small. When that performance is tied to a carefully designed investment approach and expertise in particular industries, and when the abilities involved are available to others at a reasonable price, Graham charged Heilbron $25 per month, but then that was in 1929, then investing through these individuals or institutions makes a great deal of sense. Knowing when other full-time investors are likely to outperform your own part-time efforts may be the most fundamental of all value insights. Several years ago, when Wells Fargo Bank looked like a promising investment to the value firm Tweedy, Browne, The company was about to assign an analyst to study Wells Fargo in detail. When they discovered that Berkshire Hathaway had acquired a large position in the bank, Tweedy Brown reassigned the analyst and simply bought the stock. They felt that their own research was unlikely to be superior to Warren Buffett's. Over the years, Robert Heilbrunn exercised a similar degree of judgment, enriched by his own experiences as a value investor in evaluating candidates to manage his money. He made wise choices. Walter and Edwin Schloss. Keep it simple and cheap. Walter Schloss started his limited partnership in the middle of 1955. He tracks his performance from January 1st, 1956, a date sufficiently historic to give him one of the longest uninterrupted records, same manager, same organization, in investment history. He also has one of the best. Over the entire 45-year period, from 1956 through 2000, Schloss and his son Edwin, who joined him in 1973, have returned for their investors a compounded return of 15.3% per year. During the same period, the S&P Industrial Index had comparable total returns of 11.5%. Every dollar a fortunate investor entrusted with Schloss at the start of 1956 had grown to $662 by the end of 2000, including all charges for management. A dollar invested in the S&P index would have been worth $118. The Schloss's accomplishment is even better than this initial comparison suggests. Over that entire 45-year period, their portfolio has had 7 years in which it lost money. The S&P index has had 11. The average loss in the Schloss partnership was 7.6%, in the S&P, 10.6%. A modern investment theory argues that return is compensation for risk, that higher returns are achieved only by increasing the volatility of the portfolio. The investment success of the Schlosses does not confirm the theory. Walter and Edwin Schloss are minimalists. Their office, Castle Schloss, has one room, is spare. They don't visit companies. They rarely speak to management. They don't speak to analysts. They don't use the internet. Not wanting to be swayed to do something they shouldn't, they limit their conversations. There is an abundance of articulate and intelligent people in the investment world, most of whom can cite persuasive reasons for buying this stock or that bond. The Schlosses would rather trust their own analysis and their long-standing commitment to buying cheap stocks. This approach leads them to focus almost exclusively on the published financial statements that public firms must produce each quarter. They start by looking at the balance sheet. Can they buy the company for less than the value of the assets, net of all debt? If so, the stock is a candidate for purchase. This may sound familiar. If Walter Schloss was not present at the creation of value investing, he showed up shortly thereafter. He started on Wall Street in 1934 at 18, in the midst of the Depression. During the late 1930s, Schloss took courses from Benjamin Graham at the New York Stock Exchange Institute. He was in good company. His fellow students included Gus Levy, head of the arbitrage department at Goldman Sachs, Cy Winters of Abraham, at one time president of the New York Society of Security Analysts, and other Wall Street heavyweights. At the time, Schloss was working at Carl M. Loeb and Company. Ben's brother Leon was a customer's man at the firm, and Ben kept his account at Loeb Rhodes, allowing Schloss to confirm that Graham did indeed practice what he preached in class. And he preached value, the advantage of paying less for stocks than for the value of the current assets after deducting all liabilities. A favorite teaching strategy of Graham was to analyze two companies side by side, even if they were in different industries, and compare the balance sheets. He would take Coca-Cola and Colgate, related to one another only by alphabetic proximity, and ask which stock was more of a bargain relative to the net asset values. Graham's primary concern was the margin of safety, a focus which prevented him from recognizing the great growth potential in Coke. Not all of Graham's tactics worked out. He would buy a leading company in an industry, such as the Illinois Central Railroad, and sell short a secondary one, such as Missouri, Kansas, Texas, as a hedge. As it turned out, the two securities were not correlated, and the hedge did not work. Another type of hedge, which Graham used repeatedly, was to buy a convertible preferred stock and short the common. If the common rose, he was protected by the convertible feature. If it fell, he made money on the short. In either case, he collected the dividend. This approach has become a standard practice in the industry, even though it no longer has the tax advantages it once did. Schloss sees Graham as a legitimate genius, someone whose thinking was original and often contrary to established wisdom. Graham's motivation, Schloss thinks, was primarily intellectual. He was more interested in the ideas than in the money, although that too had its rewards. Looking for cheap stocks. Ask either Schloss about their investment strategy, and you will get the same succinct response. We buy cheap stocks. Identifying cheap means comparing price with value. What generally brings a stock to the Schloss's attention is that the price has fallen. They scrutinize the new lows list to find stocks that have come down in price. If they find that the stock is at a 2 or 3 year low, so much the better. Some brokers they have done business with over the years call them with suggestions. These securities tend to be at the opposite end of the spectrum from the momentum stocks that most brokers are peddling. The Schlosses are especially attracted to stocks that have gapped down in price, stocks where the price decline has been precipitous. This taste for fiasco is very contrarian. Stock prices sink when investors have been disappointed, either by a recent event like an earnings announcement below expectations, or by continued unsatisfactory performance that ultimately induces even patient investors to throw in the towel. Over the many years, the Schlosses have managed money. They have found themselves investing in different industries, in large, medium, and small companies, in companies with shares that have plummeted in price, and in those that have slid downward gradually but persistently. The unifying theme is that the stuff they buy is on sale. The other term in their strategy is equally important. They buy stocks. They don't buy derivatives, indices, or commodities. They don't short stocks. They have in the past and made some money, but the experience was uncomfortable. They don't try to time the market, although they do let the market tell them which stocks are cheap. At some points in their careers, the Schlosses did invest in bankrupt bonds, and if the situation presented itself to them, they might again, but that field has become more crowded over the years. And like most value investors, they don't want too much company. As for ordinary fixed income investments, they steer clear. The potential returns are limited, and they can be negative if interest rates rise. Their business is making money for their partners by investing in cheap stocks. When they find a cheap stock, they may start to buy even before they have completed their research. They have at least a rudimentary knowledge of thousands of companies, and they can consult Value Line or the S&P Stock Guide for a quick check into the company's financial position. Both believe that the only way to really know a security is to own it, so they sometimes stake out their initial position and then send for the financial statements. The market today is so fast-moving that they are almost forced to move quickly. What is it worth? Valuing assets, earnings, and companies. For the 9.5 years that Walter Schloss worked for Ben Graham, and for some years after he left to run his own partnership, he was able to find stocks selling for less than 2/3 of working capital. But sometime after 1960, as the Depression became a distant memory, those opportunities generally disappeared. Today, companies that meet that requirement are either so burdened by liabilities or losing so much money that their future is in jeopardy. Instead of a margin of safety, there is an aura of doubt. Nevertheless, Walter has retained his preference for valuation based on assets. A company's assets are more stable than its earnings. If a company has a tangible book value of $15 per share, even if it is not earning money at the moment, the chances are good that the value of the assets will not drop precipitously. An investor paying $10 or even $12 per share has some comfort in knowing that the assets are there to back up the shares. And in Schloss's long experience, companies whose shares can be bought for less than the value of the assets will more often than not either return to profitability or be taken over by another firm. All of this may take time. Their average holding period for a stock is around 4 years. He has the patience to hold on. The underlying bet he is making is that overreaction by the market has offered him a bargain, and that given enough time he will be rewarded. Something good will happen, he likes to say. And in the interim, the asset value provides some protection against another steep drop in the price of the shares. Though he tends to make his initial purchase before the stock has bottomed and likes the opportunity to add to his position at lower prices, he also sleeps better at night knowing that if there is a cliff out there, his shares have already fallen over it. Edwin Schloss also pays attention to asset values, but he is more willing to look at a company's earnings power. He also wants some asset protection. If he finds a cheap stock based on normalized earnings power, he generally will not consider it if he has to pay more than 3 times book value. There are some durable companies in industries such as food, defense, and even plain old manufacturing that sell for more than book value, even when their share prices are depressed. Depending on their estimate of what the companies can earn, Edwin may still find the stock cheap enough to buy. When they begin to take a hard look at a new company, the Schlosses make sure to read the annual reports thoroughly. The financial statements are important, no doubt, but so are the footnotes. They want to be certain that there are no significant off-balance sheet liabilities. They look at the history of capital spending to see what condition the fixed assets are in. A company that has a fully depreciated plant may be reporting higher earnings than a rival that has just completed a new factory, but if it has spent its money carefully, it is likely to have a more modern and more efficient operation. 10 years of advertising expenses don't show up on the balance sheet, but do create some value for a brand, provided the company knows how to exploit it. The Schlosses are looking for recovery potential. The stocks they buy have become cheap for a reason, and their success lies in their ability to form a sufficiently accurate estimate of whether or not the market has overreacted. They do not try to get inside the business, to know the details of the operations better than management itself. They don't claim or want that expertise. Instead, they limit their exposure to any single company and use their broad and deep investment experience to guide their judgment. And because the Schlosses have been in the business so long, they have been forced to adjust their criteria as market conditions have changed. When markets are very expensive, their definition of cheap has to be somewhat more flexible and relative. As certain strategies, such as investing in bankrupt bonds, became popular, they moved to other areas. Like many great athletes and some other value investors, they let the game come to them. They have core principles that do not change. They buy cheap stocks, and they like to hold them until they have recovered. But otherwise, they are willing to take what the market offers them on the grounds that if they have bought correctly, the stock was sufficiently cheap, the chances are that something good will happen. Keeping track. The Schlosses joke that they will go to corporate annual meetings that are held within a 20-block radius of their office. Since they work in mid-Manhattan, New York, not Kansas, that is a less severe restriction than might initially appear. When they do show up, they like to be lonely, not surrounded by analysts and investment managers. Once they owned the shares of Asarco, a copper mining and smelting company. They went to the meeting and found the room full. On closer inspection, the other attendees turned out to be wives of directors, employees, and people working for the company's investment relations firm. Needless to say, the cheap stock had not yet been discovered. In this case, the company did recover from its price decline and was ultimately bought out by Grupo Mexico. Because the Schlosses hold their positions on average for 4 or 5 years, they have time to become more familiar with the company. They continue to look at each quarterly report, but they do not obsess about day-to-day price swings or 2 cents per share earnings disappointments or positive surprises. Their approach, as we said, is minimalist. If a company announces an acquisition they regard as foolish, that would be cause for concern, and they might decide to sell. Since everything about their approach orients them toward companies that are not in rapidly changing industries, where technological innovation may undermine value in weeks, if not days, they can afford to sit back and wait. They are not entirely passive. Having started with a bottom-up approach to finding a cheap stock, now that they own it, they look laterally to analyze other firms in the industry. Are these also cheap, and for the same reasons? They may decide that one of these other companies is a better investment than their initial purchase. Perhaps it is a higher quality company, with better profit margins or lower debt levels. If so, they may trade up in quality, provided they can still take advantage of the depressed status of the industry. When to buy, when to sell. The notion that an investor can buy a stock that has reached the bottom of its fall is a fantasy. No one can accurately predict tops, bottoms, or anything in between. More often than not, value investors will start to buy a stock on the way down. The disappointments or reduced expectations that have made it cheap are not going away anytime soon, and there will still be owners of the stock who haven't yet given up when the value investor makes an initial purchase. If it is toward the end of the year, then selling to take advantage of tax losses can drive the price down even more. Because they are aware that they are, to use an industry cliché, catching a falling knife, value investors are likely to try to scale into a position, buying it in stages. For some, like Warren Buffett, that may not be so easy. Once the word is out that Berkshire Hathaway is a buyer, the stock shoots up in price. Graham himself, Walter Schloss recounts, confronted this problem. He divulged a name to a fellow investor over lunch. By the time he was back in the office, the price had risen so much that he could not buy more and still maintain his value discipline. And this is one of the reasons why the Schlosses limit their conversations. Still, when asked to name the mistake he makes most frequently, Edwin Schloss confesses to buying too much of the stock on the initial purchase and not leaving himself enough room to buy more when the price goes down. If it doesn't drop after his first purchase, then he has made the right decision, but the chances are against him. He often does get the opportunity to average down, meaning to buy additional shares at a lower price. The Schlosses have been in the business too long to think that the stock will now oblige them and only rise in price. Investing is a humbling profession, but when decades of positive results confirm the wisdom of the strategy, humility is tempered by confidence. Value investors buy too soon and sell too soon, and the Schlosses are no exceptions. The cheap stocks generally get cheaper. When they recover and start to improve, they reach a point at which they are no longer bargains. The Schlosses start to sell them to investors who are delighted that the prices have gone up. In many instances, they will continue to rise, sometimes dramatically, while the value investor is searching for new bargains. The Schlosses bought the investment bank Lehman Brothers a few years ago at $15 a share, below book value. When it reached $35, they sold out. A few years later, it had passed $130. Obviously, that last $100 did not end up in the pockets of value investors. Over the years, they have had similar experiences with Longines, Wittenauer, Clark Oil, and other stocks that moved from undervalued through fairly valued to overvalued without blinking. The money left on the table, to cite yet another investment cliché, makes for a good night's sleep. The decision to sell a stock that has not recovered requires more judgment than selling a winner. At some point, everyone throws in the towel. For value investors like the Schlosses, the trigger will generally be a deterioration in the assets or the earnings power beyond what they had initially anticipated. The stock may still be cheap, but the prospects of recovery have now started to fade. Even the patience of the most tolerant investor can ultimately be exhausted. There are always other places to invest the money. Also, a realized loss has at least some tax benefits for the partners, whereas the depressed stock is just a reminder of a mistake. The portfolio. Diversification with leeway. In the minds of some money managers, diversification is a defense against ignorance. The thoroughly informed investor, knowledgeable about the industry, the company, and even the economy, can take fewer and larger positions in situations in which he or she is fully informed. Value investors come down on both sides of the question of diversification, although all of them think there is an important role for active stock selection. The Schlosses run a diversified portfolio, but they do it without prescribed limits as to the size of a position they will take. Though they may own 100 names, it is typical for the largest 20 positions to account for around 60% of the portfolio. They have occasionally had up to 20% of their fund in a single security, but that degree of concentration is a rarity. They are buying cheap stocks, we must remember, not great companies with golden futures. Though history has shown that most of their investments work out, there are always some that don't. The difficult task is to tell which will be which ahead of time. Diversification is a safeguard against uncertainty and an essential feature of the Schlosses' successful strategy. Here, as with other aspects of their approach, they rely on judgment rather than fixed rules. Although they are not going to end up with a portfolio invested in one or two industries, they will overweight their holdings when they find cheap stocks clustered together in out-of-favor sectors. At times like these, they can pick the better companies within these discarded securities. If the price of a commodity like copper is plummeted, then copper-related stocks will be on sale. Unless copper disappears permanently from use as an industrial and communications material, the supply and demand cycles have a way of righting themselves. And companies with low costs and not overburdened by debt are safe bets at these times, primarily because nobody wants to own them. A cheap price can make up for a multitude of cyclical, operational, and even managerial shortcomings. Take care of the clients. When Walter Schloss had been in business for 20 years, including several with Edwin, Warren Buffett sent a letter to some friends describing the Schloss partnership, which had then reached its 20th anniversary. Schloss left Graham Newman, Buffett told his readers, in 1955, and Graham Newman closed up in 1956. I would prefer not to dwell on the implications of this sequence. In any event, armed only with a monthly stock guide, a sophisticated style acquired largely from association with me, a sublease on a portion of a closet at Tweedy, Brown, and a group of partners whose names were straight from a roll call at Ellis Island, Walter strode forth to do battle with the S&P. We have seen the results of that contest. Other than an additional 25 years of superior performance, little else has changed. The Schloss is still sublet from Tweedy, Brown, although they have moved into a full-sized room. They supplement the monthly stock guide with Value Line and a quotation machine, and the nature of their clients has persisted, something that does distinguish the Schlosses partnership from most similarly structured funds. There are partners in the fund whose parents were partners. Some are even third-generation clients. As a group, they are not wealthy by the standards of limited partnerships. The money invested with the Schlosses is important to them, which is one reason why the Schlosses are determined not to lose it. It may also explain why the Schlosses do not disclose to their partners the names of the companies whose shares they own. In the main, they invest in unpresentable securities, stocks no one wants to brag about at cocktail parties or anywhere else. Through painful experience, agony both for the limited partners and themselves, they have found that letting the dogs out of the bag does not add to their clients' comfort level. Quite the reverse. Some people have left the fund out of fear that the beaten-down shares in the portfolio were too risky. Despite all their experience with value investing and how the Schlosses practice it, these former clients were unable to incorporate the idea that at the right price, very low, the shares of a troubled company make a good investment. The Schlosses are very attentive to the taxes their partners will have to pay. They do not like to sell shares in which they have a profit, while the sale would constitute a short-term capital gain. This occasionally may put an investment at some risk. Tax laws currently in place make it difficult, if not impossible, to protect the gain by a hedge until it goes long-term. Given the different tax rate between short and long-term gains, that is a risk the Schlosses are willing to take. There are two policies the Schlosses follow in their partnership that set them apart from most money managers running similarly structured investment funds. First, they assume that they will distribute all the realized gains to their partners each year. If a partner asks that the money be kept in the fund, they will oblige, naturally. Most partnerships require an affirmative request, made many weeks in advance, for the withdrawal of any money, whether realized gains or not. The Schlosses do not regard the money entrusted to them as captive, requiring a rescue by the partner to pry it free. This policy also helps them keep a rough cap on the size of the fund. They don't want to manage billions of dollars. Returning a large portion of the gains each year is like pruning back a shrub to the desired height. Second, the Schlosses get paid for their work by taking a portion of the investment returns. This is the typical practice for limited investment partnerships. Where they depart from the standard is that they also assume the same portion of the losses. If the fund has dropped in value over the year, the accounts of the limited partners decline less than the fund itself. The Schlosses are charged their proportional share of the loss. Also, they do not take a management fee from the fund. Most of their peers do. They only get paid for performance. As their long history shows, in 7 years out of 45, they ended up worse off than they began. This arrangement is another incentive for them not to lose money. Example 1. ASARCO. Cheap assets find a buyer. In 1999, ASARCO was a copper company with a past more glorious than its current situation might suggest. Once a member of the Dow Jones Industrial Average, it lost $1.70 per share in 1998, down from $5.65 in 1995. When the stock dropped below $15 per share, its market cap fell to under $600 million, less than the $885 million in long-term debt on its books. Yet despite all these troubles, ASARCO had a book value of around $40 per share. Its assets included its 50% ownership of the Southern Peru Copper Company, the equivalent of 1 share per each share of ASARCO. Southern Peru traded between $10 and $14 for most of the year. A purchase of ASARCO at anywhere from $15 to $20 would have the investor with a margin of safety of at least 50% based on book value. He or she would be paying between $5 and $10 for the potential earnings of the company after deducting the value of the Southern Peru share. Walter and Edwin had actually been buying and then selling ASARCO since 1993. They picked up some at around $20 and sold it out above $30 the following year. When the stock fell in 1999, they moved back in. And this turned out well. The company agreed to a merger of equals with Cyprus Amax Minerals. The larger copper firm Phelps Dodge then bid for both companies, trying to buy them before the merger. They turned Phelps down, even though its bid for ASARCO was worth around $22. Now that ASARCO was in play, it was just a matter of time before a higher offer appeared. The Schlosses finally sold their shares to Grupo Mexico for almost $30 in cash. If the assets are there, as Walter likes to say, something good will happen. Example 2. J.M. Smucker Company, selling sugar to Americans. Warren Buffett didn't say it, to our knowledge, but some of his investments, Coca-Cola, See's Candies, Dairy Queen, suggest a faith in the notion that no one ever went broke selling sugar to Americans. That is the business the Smucker family has been in for years, packaging the sugar in the form of jams, jellies, and other sweet treats. But though the company has earned money consistently, their outside shareholders have not fared so well. The shares hit a high of $39 in 1992, but from then through 1999, they seldom sold for as much as $30. Earnings varied little over this period, from $1.27 per share in 1993 to $1.26 in 1999. The book value increased from $7.55 to $11. The price-to-book ratio never fell below 1.5 to 1, and the price-to-earnings ratio only dropped below 15 on a bad day in 1999. On neither an asset nor earnings-based valuation did Smucker qualify as a value investment. Then in 2000, the price dropped below $15 per share. Food stocks in general were a depressed group, and Smucker fell along with the others. The Schlosses bought some. At that price, the company was selling for 10 times earnings, well below its historic range. Though it was not a company with a franchise, it did have an established brand and a share of supermarket shelves. On an earnings power basis, it was cheap enough to take a position. Two events made this a sweet investment. First, when Best Foods was bought out by Unilever, the prices of other food stocks rose in sympathy. Then the Smucker family, which was controlling shareholders of the firm, decided to simplify the share structure and do away with a class of supervoting stock. This reorganization made the stock more liquid and also introduced the possibility that the company could be taken over now that the supervoting shares were eliminated. Thanks to Unilever and the family, the stock rose from $15 to $25 within 7 or 8 months. The Schlosses now had to choose between taking a short-term capital gain, not something they like, or continuing to hold a stock after it had ceased to be cheap and may have become overvalued. They took the rational course and decided that paying the tax would be less painful than seeing the shares decline to $15. Naturally, the stock rose to $27 before the end of the year, but now, at this higher price level, it is someone else's worry. Mario Gabelli. Mario Gabelli graduated from Columbia Business School in 1967. He had been a student of Roger Murray, who kept the value flame alive after Ben Graham and David Dodd retired. For the next 10 years, Gabelli was a sell-side analyst, first in the automotive industry and then in entertainment. In 1977, he formed Gabelli Asset Management, GAMCO, and began his career in active investing. He took the company public in 1999. After a long record of superior returns, the firm managed $36.5 billion at the end of 2019. From the start, he had been a bottom-up investor, carefully researching individual companies. He estimated a company's value as the sum of the values of the individual divisions for which financial information was available. At the company level, he then considered how this sum of the parts value would be affected by the quality of corporate management, especially with regard to capital allocation. Gabelli did not adjust his investments based on forecasts of macroeconomic variables such as interest rates or overall financial market conditions. Having entered the business in the late 1960s at a time of high valuations, Gabelli recognized, as did Warren Buffett at about the same time, that successful value investing could no longer rely on finding Graham-type net opportunities. Few, if any, companies were selling at less than 2/3 of net working capital, less all other liabilities. He was forced to look for better businesses with favorable long-run prospects, whose value often depended on cash flows in the distant future. Unfortunately for Gabelli, he understood that commonly used discounted cash flow estimate of intrinsic value were highly sensitive to assumptions about future growth rates and costs of capital. He had to look elsewhere to find reliable intrinsic value estimates. Gabelli's innovative response to this challenge was to look at what he referred to as a company's private market value, or PVM. He defined this as the price an informed industrialist would be willing to pay to purchase assets with similar characteristics. These prices could be deduced from transactions in which whole companies, divisions of companies, or individual assets such as cable television systems, changed hands. Prices could be scaled against both accounting measures, such as dollars paid per dollar of average EBITDA, and direct operating statistics, such as dollars paid per cable customer acquired. Gabelli developed systematic databases of relevant transactions. The advantages of this approach were twofold. Instead of relying on the market price, and by extension, projected earnings and cash flows, it had a grounded estimate of what a knowledgeable buyer might pay, and the industrial buyer incorporated in his or her price the value of a control premium due to improved management and any other hidden potential in the underlying business, such as local synergies with existing businesses. At the same time, Gabelli recognized that private market values could be relatively unstable, fluctuating with overall market conditions. The sooner the overall market value was embodied in the market price of a stock, the lower the risk that it might be undermined by adverse market developments. So Gabelli looked for catalysts that would lead public market prices to converge with private market values. Catalysts could be company-specific events, takeover bids, management replacements, corporate restructurings including spin-offs and share repurchases, or developments affecting whole industries, such as regulatory changes or shifts in demand. These catalysts would draw positive attention to the investment in question and lead either directly, as in the case of takeovers, or indirectly to increases in the public market price. Private market values plus catalysts have become a defining characteristic of Gabelli's investment strategy. Glenn Greenberg. Glenn Greenberg's successful career in investing is a tribute to the value of general ability and education rather than either technical training or early experience. At Yale, he studied English literature. His first job after graduation was teaching, first in elementary school and then in high school, where he also served as a principal. Since his greatest satisfaction came from managing the school, he took his boss's advice that he develop his managerial talent by going to business school. At Columbia Business School, the two projects that appealed to him most were first, the analysis of a company from the perspective of a potential investor. He picked TWA and advised against investing in it. And second, a detailed and critical study of his family's business, Gimbel Brothers, which also owned Saks Fifth Avenue. When he graduated in 1973, he considered positions in consulting and investment banking, but decided to join the asset management department of J.P. Morgan. His experience at Morgan was very useful. As he has said, he learned how not to manage money. Managers assembled their portfolios from an approved list of supposedly impregnable companies about which they were largely ignorant. From the beginning of 1973 to the end of 1974, portfolios of these stocks fell by 40% or more, no better than the S&P 500. In 1978, Greenberg moved to a smaller firm, whose typical portfolio held 10 or fewer stocks, each of which had been exhaustively researched. There he learned to be skeptical of the prevailing wisdom and to make sure that he personally understood the reason for investing in any stock owned. In 1984, Greenberg and John Shapiro established their own firm, Chieftain Capital Management, based on these investment principles. They would not initiate an investment in a stock unless they were confident that their knowledge of the business justified an investment of at least 5% of their assets. They also intended to hold these positions for extended periods. They made only a few investment decisions in any year, allowing them to do extensive research on each firm they selected and on those on which they passed. All of the firm's 4 professionals were fully informed about each decision. They attended company meetings, individually scrutinized all financial filings, and tracked industry developments. They had to unanimously agree on all purchase decisions. They continued to devote the same scrutiny to companies already in their portfolio. The consequence of this focus was that Chieftain was better informed than most industry experts and seldom relied on outside opinions, which they generally found mistaken. In selecting investments to target, Greenberg looked at a universe confined to hundreds of large, stable companies with strong competitive positions, high returns on capital, and the ability to distribute cash to investors even as they invested for rapid growth. These opportunities were characterized by 3 features. First, Greenberg looked for good businesses protected from relentless competition. They were often duopolies with histories of successful coexistence, or local monopolies, such as cable systems, whose profitability was not threatened by government intervention. He also sought out companies that could grow by taking market share, such as Airbus, Progressive, or HCA. Second, he looked for managements devoted to shareholder interest. That meant a focus on efficient operations, value-enhancing capital allocation, and the distribution of excess funds, either as dividends or share buybacks. Finally, Greenberg sought a price for these purchases well below their values conservatively measured. Greenberg was not interested in speculating on potential improvements, either in management or the industry. He was not attracted to turnarounds. Rather, he looked for good businesses whose market prices were depressed by misperceptions of current or anticipated difficulties. For example, he was an aggressive purchaser of cable stocks where there was widespread concern, which he thought mistaken, that satellite competition and cord cutting would limit cable's growth. COVID-19 presented many opportunities as investors confused a short-term event with a permanent reduction of corporate value. In 2010, Greenberg and Shapiro separated, and Greenberg established Brave Warrior Advisors. He continues to place all his eggs in a small number of baskets and to watch those baskets very closely. The basket now includes technology stocks, as his partners are of a younger age and able to help him figure out which of these faster-growing companies embody qualities he has always valued. Paul Hilal. Paul Hilal was raised in a distinguished academic and medical family in New York City. After completing his undergraduate, B.A. Biochemistry, Harvard 1988, and graduate studies, J.D. and M.B.A. Columbia 1992, he spent 5 years doing M&A advisory work at Broadview Associates, the leading advisor to the tech sector at the time. After 5 intense years at Broadview, he took a sabbatical to travel around the world. In January 1998, he joined his elder brother Peter's value-oriented investment management firm, Hilal Capital Management, where he created and ran the firm's information technology investment program. While there, he uncovered untapped potential in publicly traded World Talk Communication, a struggling software vendor. He led the fund's significant investment in the company and took charge as board chairman and acting CEO from 1999 to 2000. The reorganization, restructuring, and sale of the firm were highly profitable. The experience forever changed Hilal's thoughts on investing. In 2002, Hilal opened his own investment management firm, Caliber Capital Management, to pursue a small number of concentrated investments, primarily focused on IT companies. In December 2005, his college roommate and close friend Bill Ackman asked him to join Pershing Square Capital, where Hilal could increase the scope and scale of his activities and yet continue to practice his focused investment style, including active engagement with management. The 6 investments on which Hilal worked over the subsequent decade, including 3 high-profile projects, expanded Pershing Square's reach into a number of new industries. His first venture involved the transformation of an IT company like WorldTalk. In this case, it was industry laggard Ceridian. Pershing Square secured seats on Ceridian's board for Hilal and 3 other nominees. Almost before the ink was dry, Ceridian received an offer for the whole company so attractive that Pershing accepted and abandoned its longer-term restructuring plans. It was a bittersweet outcome for Hilal, who had looked forward to improving Ceridian's performance. Hilal's next public engagement was far removed from IT. Long study had convinced him that railroads represented a fertile ground for his concentrated, activist approach. The Canadian Pacific, CP, one of 2 Canadian transcontinental railroads, was North America's worst performer. Hilal believed its operations could be quickly and materially improved despite management's claims that structural challenges specific to CP limited its performance. Based on his now extensive industry knowledge, Hilal identified and recruited a replacement CEO capable of transforming CP. Hunter Harrison was a respected but controversial railroad operator who had been forcibly retired by the board of industry leader Canadian National despite having greatly improved its performance. Hilal initially sought to reach an agreement with CP's board for a cooperative restructuring. When that did not work, Pershing Square initiated a proxy contest and won support of 90% of the shareholders and board seats for all 7 of its candidates, including Hilal and Ackman. Harrison was installed and began a successful transformation of CP's operations. Hilal's next project again involved months of study of a new industry, this time industrial gases. As a fixed facility distribution business, it bore some similarity to railroads. He again identified a specific target for restructuring: air products and chemicals. Of the four major industrial gas providers, Air Products was the worst performer. Benchmarking it against Praxair, the industry leader, revealed that Air Products had room for major improvement. As he had done with CP, Halal found and recruited an exceptional manager to transform the company. Saifi Ghasemi was a well-respected industry veteran. Pershing Square negotiated a settlement with the existing management that led to board representation and the installation of Ghasemi as CEO. Restructuring, including a spin-off, and dramatic operational improvement followed, sharply increasing the value of the company. These three projects, along with three smaller investments, were responsible for a substantial fraction of Pershing Square's returns during Halal's tenure. He left in January 2016 with Ackman's support to form his own firm, Mantle Ridge. He defined Mantle Ridge's mission as creating value through the focused engagement with companies, which he had practiced successfully at Pershing Square. Halal's first target at Mantle Ridge was CSX, another underperforming railroad. He again selected Hunter Harrison as his change agent. In order to install Harrison at CSX, Hilal had not only to gain the agreement of CSX's board, but also to induce CP to release Harrison from his current management obligations and a non-compete contract. This part of the task took $100 million. An agreement with CSX soon followed. Halal and four others from his team joined the CSX board, and Harrison became CEO. Although Harrison died only 9 months after this move, the transformation was still completed, and the railroad's value more than doubled. Hilal's guiding principle at Mantle Ridge was that professional investors assume stewardship of their partners' precious capital. Boards and managements assume stewardship of industry and the interests of the shareholders and other corporate stakeholders. Engaged professional investors do both. His success in applying this principle depended on constructive and cooperative engagement between boards, management teams, and engaged shareholders. The key to making this approach work is comprehensive industry knowledge on the part of the engaged shareholders, which is acquired with an industry-focused, if serial, specialization of the kind that Paul Halal has practiced throughout his career. It also requires the discipline needed to pass on all but a few extraordinary opportunities to which the necessary unremitting attention can be applied. Jan Hummel. Jan Hummel, perhaps unusual for someone growing up in the countryside in Sweden, bought his first share of a Swedish IPO at the age of 16. He graduated with an MS from the Stockholm School of Economics and was awarded a fellowship to study financial economics and mathematics at Stanford. He was then recruited to Booz Allen Hamilton in London. Subsequently, Hummel received his MBA from Harvard Business School, where Bruce Greenwald was one of his professors. His first position after business school was as an investment banker with Merrill Lynch. Attracted more to investing than investment banking, he left Merrill to pursue turnaround and restructuring opportunities in a private equity setting. After several years, he recognized that much of the benefit of private equity investment was dissipated in the often frenetic bidding for deals, raising the costs and lowering subsequent returns. As a result, he turned his attention to investing in publicly traded equities and started Paradigm Capital in 2001 as a private investment company. His focused strategy and strong track record attracted Mario Gabelli's participation. In July 2007, he founded the Paradigm Capital Value Fund, one of Europe's first value investing funds, with his own capital and Gabelli's group as an anchor investor. Hummel focuses on smaller and medium-sized businesses. He typically invests in companies with market capitalizations between 200 million and 5 billion euros. This is an area of the market generally ignored by the large institutions, major banks, insurance companies, and pension funds that dominate the investment scene in Europe. With many billions of euros under management, it is rarely worthwhile for them to look at companies of this size. In Paradigm Capital's universe, shareholders tend to be relatively conservative family business owners, individuals, and smaller institutions. Hummel invests exclusively in companies located in Austria, Germany, Ireland, the Nordics, Denmark, Norway, Sweden, and Finland, and the UK, countries that benefit from good corporate governance and well-regulated securities markets. Only a limited number of companies fit Hummel's size, geographic, and business quality criteria, allowing him and his team of analysts to closely study the firms and managements within this universe. Hummel looks for franchise firms earning high returns on invested capital, whose operations are protected by strong barriers to entry. These franchises, given the size of his target companies, are necessarily local, dominating their markets either geographically, or if they sell globally, focused on narrow product niches. They are often service businesses with local economies of scale in purchasing, advertising, sales, service infrastructure, and management. Examples include local distribution businesses for both people, e.g. airlines, and goods, e.g. logistics, retail and wholesale companies, local contractors, e.g. plumbing and electrical, real estate and education, and financial service providers, e.g. specialty insurers, locally focused banks. One particularly promising category is manufacturers for whom production costs are low relative to local sales and service costs. They are often evaluated as small manufacturers rather than locally dominant service providers. Hummel seeks to acquire companies below or at fair value, often when an opportunity for value enhancement is available to an engaged investor, such as growth, typically in an adjacent market, capital structure optimization, changes in top management, or possibly a complementary acquisition. Hummel looks for high-quality managements along several dimensions. First, he wants a relentless focus on efficient day-to-day operations. Second, he seeks a growth strategy that creates value by investing only when the returns on growth exceed the cost of capital. In practice, this means expanding in markets into which existing economies of scale carry over. Finally, Paradigm Capital looks for management that is attentive to its shareholders, distributing any funds that cannot be profitably invested in the business and financing the business in the most efficient way possible by using appropriate amounts of debt and not holding excess cash. Executive compensation should typically be tied to long-term returns on capital employed. The limited geographic footprint of its investments allows Paradigm Capital continuous access to management. Hummel is not shy about conveying his views to them if he feels they need to improve their operations. Attractive buying opportunities often emerge from material underperformance, even in companies in which Paradigm Capital is already a shareholder. His preference is to establish a cooperative relationship with a company, to be a suggestivist rather than a traditional activist who is apt to use a more forceful approach. If necessary, Paradigm has taken control of companies and installed new people with proven managerial talent. Its successes in these instances have depended on Paradigm's ability to identify capable, locally available managers, all made possible by its geographic focus. Hummel considers a concentrated portfolio to be a critical part of Paradigm Capital's success. The portfolio has around 75% invested in a set of around 10 positions, each accounting for about 6 to 12% of the fund. These major positions are typically held for extended periods. Before investing, Hummel must be thoroughly familiar with their business operations and their managements. The remaining 25% consist of promising exploratory positions, of which there are up to 10, some event-driven holdings that are cash-like, and cash itself. After initial purchase, these exploratory investments are subjected to continuous attention, including developing a relationship with and an evaluation of management. Only a few become full positions, a decision very much driven by the valuation and thus the expected return. The process by which Paradigm Capital selects these exploratory positions begins with about 50 to 70 ideas a year, of which around 20 survive a preliminary screening. Each of Paradigm's 5 analysts investigates about 4 to 6 of these 20. They are assigned based on industry or other specialization. The list is further winnowed until only about a handful are left, 1 per analyst. These become exploratory investments, each followed intently by the analyst who recommended it. Ultimately, they are either dropped or elevated to one of the major positions in the portfolio after a discussion by all investment professionals. Companies that do not make the final cut are added to a library of target companies so that Paradigm can move quickly if prices fall sufficiently to make the investment attractive. Risk management plays an important part in Hummel's investment philosophy. It is handled by requiring a margin of safety before any money is invested. Diversification also reduces risks. In vulnerable market periods, when both prices and investor confidence are high, Hummel reduces market risk further with various derivative positions that in these circumstances are often available at relatively low cost. In these periods, Paradigm Capital also holds cash or cash-like arbitrage and other event-driven positions intended to produce higher than pure cash returns. Paradigm Capital considers itself to have no edge in determining the future of currency movements and therefore hedges all non-euro positions. And for overseas U.S. investors, it hedges out the overall currency risk between the euro and the dollar. As a consequence, Paradigm Capital's value investment strategy, coupled with strict risk discipline, has produced returns with very low correlation to the market. Paradigm Capital creates its edge through highly disciplined, deep, fundamental research. Its overall strategy is to look within its intentionally limited universe for 1. Good businesses with 2. High-quality management, 3. Good corporate governance, and 4. Competitive advantages, or 5. Assets at advantageous prices. Through this focused approach, Hummel has made investments that earned well above the market returns without any financial leverage, showing that traditional value investing principles of sticking with quality and buying what one knows are still as relevant in Europe as ever. Discipline, focus, specialization, and hard work, coupled with careful risk management, have done well for Paradigm Capital and its investors. Seth Klarman. Seth Klarman began investing as a teenager and was introduced to value investing during his college years. He worked with Max Hein and Michael Price for a summer while in college, and then for 18 months before he entered Harvard Business School. When he graduated in 1982, 2 faculty members hired him to help manage their wealth and that of 2 other families. After an extensive search of outside investment advisors, they decided that Klarman himself could probably do a better job than any of the available alternatives. That decision must rank as among the very best in the history of money management. They established the Baupost Group with Klarman as portfolio manager and began investing in early 1983 with $27 million in assets under management. By the end of 1999, assets under management were approaching $2 billion without having raised any significant amount of outside funds. That figure had grown to more than $28 billion by the end of 2019. Klarman has been in an unusual position at Baupost. Most institutional investment managers control only a portion of their clients' wealth. As a result, they are not primarily risk managers, although risk controls affect their investment choices. Baupost continues to manage significant assets for its founding families, as well as of the assets of many of Klarman's employees who have made a point of eating their own cooking and collectively making up the firm's largest client. It is no surprise that Klarman's most treasured book on investment should be titled Margin of Safety: Risk-Averse Investing Strategies for the Thoughtful Investor. Baupost's goal is to achieve attractive, risk-adjusted returns over an extended period of time. In implementing his approach, Klarman begins to look at all investments by asking, "What is my edge?" He realizes that every time he purchases an asset, thinking it will be a good investment, someone else is selling it, usually with a less positive view on its value. Without an edge, Klarman has no reason to think that over time he will end up on the right side of the transaction more often than not. Fortunately, Baupost's structure and its long-term relationship to its clients means that Klarman has patient money, does not have to respond to daily market pressures, and can weather any short-term adverse developments without having to sell his investments at inopportune times. Klarman focuses on markets and securities with motivated or unreflective sellers. These include distressed fixed income securities being disposed of by managers who are constrained to hold only investment-grade assets, spin-offs from larger companies, the stocks of which are almost automatically sold by money managers for materiality reasons, distressed or non-performing assets being sold by financial institutions, assets sold by government agencies, such as the Resolution Trust Company in the early 1990s, forced to dispose of assets from failed savings and loan banks and other institutions that had acquired them for reasons of economic stability. Stocks removed from a market index that must be sold by index funds, and less than prime real estate, such as half-empty buildings or other hard-to-sell assets. Another attractive characteristic of these kinds of markets is that Klarman faces much less competition from other well-informed and liquid buyers. Over time, however, as investors discovered such opportunities, other buyers arrived and bid up prices. Klarman was forced repeatedly to find new fields in which to prospect. For example, Klarman developed a network of local real estate operating partners for whom he was the primary or exclusive source of sophisticated, ready-to-act external capital. In selecting particular investments, Klarman concentrates first on the downside, which he defines as the likelihood and magnitude of permanent loss. This approach enables him to acquire assets with volatile prices, but generally predictable long-run value. A case in point was his acquisition of senior Texaco bonds in the 1980s. In response to an adverse legal judgment, Texaco was forced to protect itself by declaring bankruptcy and halting interest payments on all its debt. Interest due continued to accumulate during the process of reorganization, but Texaco owned assets that fully covered the outstanding principal and many years of accumulated interest on the senior debt, even after an adverse legal judgment. The investment uncertainty stemmed largely from the timing of this return, not its eventual payment. Unless resolution of the bankruptcy took an unusually long time, the bonds were selling at a price that was likely to produce an annualized return of at least 15%. But the prices of the bonds might fluctuate in the interim in response to developments in the bankruptcy process. Having a long-term perspective and defining risk as permanent loss of capital, Klarman was immune to these concerns. As things worked out, he earned an annualized return of well over 20% over a few years with little risk. Another example of a distressed credit with limited downside risk and sizable upside was in the debt of Enron. Enron bonds were selling at pennies on the dollar after a major fraud was exposed. While the exact value of the assets was uncertain, the market price of the bonds seemed to incorporate an excessive discount for the risks. Klarman has other advantages. He combines a high intelligence, not a rarity in the profession, with an exceptional discipline that helps keep him immune to the pull or push of market trends or other enthusiasm. He and his firm do meticulous research, and because of his stellar reputation, he has the ability to attract and retain first-rate people. However, the extraordinary results he has achieved might not have been possible with less patient investors and more focus on, "What have you done for me lately?" He has also built a cohesive firm with a strong culture of collaboration and a drive for excellence. Michael Price. Michael Price's long and successful career as a value investor began when he became a research analyst for Max Hine, a legend in the field, shortly after graduating from college in 1973. When Price started at Hine Securities, its fund Mutual Shares series had roughly $5 million under management. When Hine died in 1988, Price succeeded to control of the firm. He sold it in 1996 to Franklin Resources, but continued to manage the funds until 1998. By that time, assets under management exceeded $15 billion without any substantial advertising, promotion, or sales commissions. The growth came from outstanding investment performance that did not deteriorate as the funds grew in size. The record provides testimony to Price's investing abilities and the strength of the value approach he practices. Price embraced an eclectic approach to investing. Most funds were invested in value equities, with the intention of holding them for extended periods. Price also invested in event-driven return opportunities, including bankruptcies and reorganizations, which were a specialty of Max Hine, merger arbitrage, and activist intervention. In constructing his portfolio, Price aimed for a 15% return with limited downside risk, all based on acquiring assets and businesses at a price that afforded a large margin of safety. Long-term value equity investments typically made up 2/3 of the portfolio. These investments were widely diversified and spread among dozens of stocks. Price looked for a discount between price and intrinsic value of 30 to 40% in the stocks he purchased. To find these companies, he had to avoid areas in which manic investor enthusiasms, as in the dot-com bubble, or the promotion activities of Wall Street firms, as in hyped IPOs, created inflated prices. He was patient and disciplined, sometimes waiting years for a stock to meet his price requirements. The remaining 1/3 of the portfolio consisted of event-driven investments that Price regarded as having cash-like values independent of overall market fluctuations. Carefully selected merger arbitrage opportunities would often yield annualized returns of 15% or more. The risk that these deals would collapse and produce negative returns was not correlated with whatever the overall market was doing. By investing in 5 to 10 carefully selected deals from the hundreds available, the risk of a deal breaking could be minimized and largely diversified away. At that same time, Price always held at least 5% of the portfolio in cash. His balanced portfolio had a record of stability, with major declines 40% less severe than those of the stock market as a whole. Price's approach to estimating intrinsic values relied heavily on private market valuations. He began by examining individual operating businesses and assets using available financial data. For each, he looked at the historical record of what a knowledgeable buyer was willing to pay for a similar asset. Much of this information comes from merger and arbitrage transactions, which are accompanied by detailed investment banking analysis of each revenue stream and the non-operating assets, such as holdings of publicly traded securities. Systematic collection and analysis of the information for relevant, recent transactions reveal what knowledgeable buyers have been willing to pay for similar operations. Summing the values of the individual pieces that make up a company will yield something like a maximum value. If the current market price of the company under examination is at or above this value, then the company's stock is a poor bargain and to be avoided. In the first edition of this book, Price did such a calculation for General Electric, at that time one of the largest companies in the world, which showed that the stock was significantly overvalued. The much touted positive synergies tend to be minimal or non-existent. On the other hand, poor overall company management may destroy a significant part of whatever potential synergies exist. So the last step in Price's analysis was to examine carefully the historical performance of the firm's management. If this showed major value destruction, Price was prepared to intervene, as he did successfully with Chase Manhattan Bank in 1995. After selling Mutual Shares in 1995, Price has continued to manage money for himself, some friends, and a few institutions. His investment style has not changed. He is focused and efficient in looking for potential buying opportunities. If an intrinsic value calculation of a promising firm shows that the price is not cheap enough to buy, he does not simply discard the work and move on. He continues to follow the firm and increase his understanding, so that if it trades at a price which provides a sufficient margin of safety, he is ready to act quickly. After he has sold a firm because it became fully priced, he keeps track of it in case the price retreats to make it a bargain again. He applies this discipline to bankruptcies. He follows a firm through every stage of the process, from pre-filing distress to the filing itself, through the various reorganization plans, and finally, emergence from bankruptcy. At each stage, he is prepared for any attractive investment opportunity that appears. Price begins the search for new opportunities with a careful reading of the business press. He is not interested in general market information. He looks for company news, especially bad news, and industry developments, such as consolidation through mergers, that are likely to alter market prices and intrinsic values, and may thus create new opportunities. He then has his team begin a comprehensive analysis of any affected company, including its particular position in the industry and its management. Price's underlying strategy is to be patient in waiting for opportunities and well prepared to act quickly when they appear. Thomas Russo. After graduating from Dartmouth in 1977, Thomas Russo enrolled in Stanford in 1980 for a joint JD/MBA degree. In the business school, he took a course from Professor Jack McDonald, who, in the face of a finance department deeply committed to the efficient market theory, taught value investing in the Graham and Dodd tradition. A guest appearance during the course by Warren Buffett cemented Russo's attachment to value principles. He graduated in 1984 with degrees in law and business and was hired by the investment firm Rowan Cunniff to work in their Sequoia Fund, one of the funds that Buffett profiled in his famous Super Investors of Graham and Doddsville article. After 5 years, he left for Gardner, Russo and Gardner, where he managed the Semper Vic family of funds ever since. Russo's investment approach is rooted in 3 fundamental principles. First, he looks for 50-cent dollars, stocks selling at 50% or less of his estimate of intrinsic value. Second, he focuses on companies with both great brands and significant opportunities to reinvest in the extension of these brands at attractive returns. Third, he looks for companies and managements that have a capacity to suffer, by which he means the willingness to make long-term investments at the expense of current reported earnings. Short-term investors often respond to a decline in earnings by selling the stock and driving down the price until it meets Russo's 50-cent dollar criterion. For the great brands, companies in which Russo invests, those that can earn more than the cost of capital on their investments for growth, the long-run benefits ultimately become apparent and the stock price rises. One example of this process was the global expansion of Brown-Forman. The company's whiskey brands, most notably Jack Daniel's, were popular in the U.S., but had only a small presence internationally. Since domestic sales were stagnant, the most obvious path to growth was overseas. At the time, foreign sales accounted for less than 10% of total company revenue. The campaign to increase foreign sales was costly. It involved funds for advertising, distribution, and sales that increased operating expenses well in advance of any corresponding increase in revenue or income. The result was declining reported earnings for a company that continued to show stagnant overall sales. The stock price declined enough to meet Russo's 50-cent dollar requirement. Ultimately, overseas sales came to represent half of Brown-Forman's revenue, and profit grew accordingly. Russo saw a similar pattern in the development of the House and Garden cable television HGTV channel. House and Garden was part of E.W. Scripps, a family-controlled business that owned newspapers, magazines, and local television stations. Creating programming and arranging distribution increased expenses well ahead of any visible benefits. But with patience, Scripps and Russo saw the investment pay off. Ultimately, HGTV added more than $1 billion to Scripps' value. The success of these investments depended on two factors. First, the opportunity to earn a return above the cost of capital by extending a brand's geographic reach, in the case of Brown-Forman, or to expand existing content to new channels of distribution, in the case of Scripps, must actually be there. Russo had to be able to distinguish between strong brands with profitable reinvestment prospects and weak ones with limited ability to move into new markets. Second, management must be capable of accurately identifying the markets and be willing to accept short-term pain while still executing the expansion strategy effectively. Identifying managers with these skills requires detailed familiarity with managers across an industry. Russo has developed this expertise by focusing on a few industries, chiefly consumer brand businesses, and on the managers who work in them. Over time, he has recognized that family-controlled businesses are a particularly fruitful area on which to concentrate. The family-controlled firms tend to take a much longer-term view than companies with managers who need to respond to the market's reaction to quarterly results. Also, in a world in which most companies are led by professional managers with negligible ownership stakes, there are often irrational prejudices against family-owned firms, which tend to reduce their share prices. Sometimes these judgments are justified. Within his target industries, Russo is especially attentive to how effective family management, often overseas, can be distinguished from dysfunctional ones. To make the most of his specialized knowledge, Russo has had to invest globally. He was an early leader among U.S. value managers in looking abroad. He has also run a concentrated portfolio. At the end of 2019, Russo's top 5 positions accounted for roughly half of his roughly $13 billion portfolio. 4 of these were widely recognized global consumer brands, including MasterCard, and the other was his longtime holding in Berkshire Hathaway. His next 10 investments accounted for another 40% of the portfolio. They included 6 global consumer brand companies and 3 companies that, like Berkshire, he had followed for his whole career. One of these was family-controlled. The remaining 10% of the portfolio was made up of around 30 small positions, some exploratory and some in the process of liquidation. Many of these were also global consumer brands. With a concentrated portfolio and a long holding period corresponding to his long-term investment horizon, Russo makes only a few major investment decisions each year, allowing him to run with a small research staff. He is very much in the put your eggs in one basket and watch that basket carefully school. Among the concentrated value investors who were the subjects of a careful comprehensive study by Carla Knobloch, it was those with specialized expertise who performed best. Russo was first among them, but his long-term success has required the right kind of investors. As he acknowledged, I have been very fortunate in having been provided with the capacity to take my time in earning returns. Andrew Weiss. Andrew Weiss began his professional career as an academic economist. He majored in political economy at Williams College, and after spending a few years as a public school teacher, he earned a Ph.D. in economics from Stanford University in 1977. He then taught economics at Columbia, while also working as a member of the economics group at Bell Labs, then one of the world's preeminent research institutions. In 1986, he moved to Boston University, where he remained until retirement. The papers he published, widely cited, earned him a distinguished reputation. During this period, he was a highly disciplined and successful investor, first of his own and some family money, and then establishing a fund in 1991. When he tired of the politics and administrative demands of faculty life in 2004, he became an emeritus in order to focus on investment management. As an investor, Weiss has always been attracted to overlooked investments that are undervalued because they are obscure and complex rather than individual stocks. In the late 1960s, When U.S. investors were almost exclusively focused on U.S. securities, he looked overseas. He became interested in Japanese industrials at a time when Japan, before its days as an economic powerhouse, was known chiefly as a producer of simple, cheap, and low-quality consumer goods. He identified a U.S. closed-end fund that invested in Japanese manufacturing stocks. A closed-end fund, in contrast to the much more common open-end fund, sells a finite number of shares to the public in an IPO and invests the proceeds. Those shares then trade on a stock exchange. Although the holdings of the fund are publicly known and the net asset value of the fund can be easily calculated, the fund often trades at a discount to this value and less frequently at a premium. Weiss saw that while the companies in the Japan fund were trading at very low earnings multiples, sometimes as low as 5, his own research had found strong growth prospects for the Japanese economy as a whole. The shares of fund itself traded at a significant discount to the market value of the stocks in the portfolio, and there was a possibility of the fund liquidating in the future, at which point the underlying stocks would be sold and the proceeds distributed. All of this, though obvious to Weiss, was either overlooked or ignored by investors who had disdain for the Japanese companies. As Japan gained recognition as an industrial powerhouse, the underlying shares appreciated in value. By the early 1980s, the Japanese stock market was fully valued, and Weiss sold his position. Weiss's return benefited both from the repricing of these shares and the narrowing of the discount at which he had originally bought them. The complexity and obscurity created a double margin of safety, cheap stocks selling at a discount to their market value. He also began to focus on complex investments in more established markets that leveraged his economics expertise to find opportunities that markets were mispricing. For example, in the manically optimistic atmosphere associated with German unification in the early 1990s, not only did German stocks appreciate into bubble territory, but the Germany Fund, a closed-end fund investing in German securities, traded at a price that was well above the value of the securities in its portfolio. The stocks themselves had run up considerably in response to a macroeconomic change that, according to Weiss's analysis, was not going to improve their future earnings. Subsidies to East Germany paid for by West Germany was not going to help the after-tax earnings of West German companies. Weiss began managing money professionally in 1991, and he continued to apply the two principles evident in his Japanese investment. He looked at opportunities globally, often in overlooked, undesirable markets, and he sought out complex securities that he could buy with a margin of safety by investing in the highly diversified portfolios of closed-end funds. In the 1990s and early 2000s, those opportunities often lay in the post-communist countries of Eastern Europe and former Soviet states such as Kazakhstan. At the time, governments were privatizing the state-owned enterprises by distributing the stock among their workers. The workers, in turn, having no aptitude for or interest in stock ownership, simply dumped the share on newly established local stock markets. At the same time, rampant corruption and a tradition of dishonest reporting deterred most overseas and many local purchasers. As a result, many of these companies sold at a tiny fraction of their asset values and as low as 1/2 their annual earnings. Several closed-end funds, organized to take advantage of these bargains, were selling at significant discounts after the promised high returns did not materialize immediately. Weiss, who is naturally risk-averse, ultimately found opportunities to invest in funds at prices that more than compensated for the risk and that were relatively well managed. In some cases, he was buying shares for less than the value of the entitlement to cash held by the fund. He was getting an interest in operating companies for less than zero. Another opportunity arose in the mid-1990s from geographic differences in opinion about the prospects for Brazil. A Brazilian closed-end fund traded in Europe at a significant premium. At the same time, a fund with similar holdings was trading in Argentina at a large discount. Buying the Argentinian fund while shorting the European one provided a high expected return at low risk. Financial disaster created other opportunities. Just as U.S. mortgage securities in the early 2000s were sliced and diced to create a spectrum of safe to risky opportunities, in the 1990s, British asset managers had created sliced and diced securities based on ordinary debt or equity portfolios. The constituent securities were referred to as splits. An extra level of complexity was added by the fact that there were several different constituent securities, each of which had different governance rights as well as different priority of claims in the event of payment suspensions. When the values of the underlying securities collapsed in the spring and summer of 2002, there were widespread suspensions of payoffs to holders of a share class who thought that all the dividend income would automatically be distributed to them. Investors whose supposedly safe securities proved very unsafe dumped them without performing the complicated calculations necessary to determine the true value. Weiss and his analysts developed careful methods to value the underlying securities and also the administrative and legal capacity to enforce the legal entitlements and to exercise associated governance rights, which often required physical presence at meetings in the Channel Islands or Scotland. Finally, there are often systematic, local anomalies that create attractive opportunities. Korean companies have always issued both ordinary and preference shares. These preference shares are quite different from the preferred stock issued in developed financial markets. They have the same fractional claim on a company's earnings as the ordinary share, but they pay slightly higher dividends. On the downside, preference shares have no votes in corporate elections and other matters that don't directly affect the preference shares. Since most Korean managements operate without any shareholder input, this is a minimal sacrifice, yet the preference shares trade at sometimes substantial, often greater than 50% discounts to the ordinaries. The problem is that these discounts vary markedly across time and companies. Weiss and his associates studied the historical variations in discounts and developed a portfolio of preference shares that they could hedge with the corresponding ordinary shares. Given the seemingly endless global capacity of investment banks to create such complex instruments, opportunities of this sort seem to be continuously available. Weiss has built a firm with the analytical and administrative capacity to exploit them effectively, as well as to be creative in the forms of financing they can offer to firms whose structure and needs made them a poor fit for the terms and conditions of the customary commercial or investment bank contracts. This highly focused organization, with about $2 billion under management, has produced healthy returns from 1991 through the end of 2019 with no down years.